Moody's downgraded U.S. debt over the weekend. We'll be talking about what this means for the economy and the markets. Bond markets continue to grind a bit lower with the yields going up, and the stock markets are on their fourth week or fifth week of recovery straight. We'll talk about what's next for the markets with Ted Oakley, founder of Oxbow Advisors, and Ted has a new book, Second Generational Wealth. What do you want for your kids? This is a very interesting read about passing your wealth down to the next generation. We'll be pulling some quotes of wisdom from the book. Thank you for joining the program once again, Ted. Good to see you.
Thanks, David. Good to see you.
Like I mentioned in the very introduction, we have this V-shaped recovery in the markets that's lasted a couple weeks now straight. And I'm going to get your outlook on what's going to happen next, whether or not this is the beginning of the end for the bear outlook. But let's talk about this U.S. debt issue first. So Treasury Secretary Bessent called this downgrade a lagging indicator. I think Moody's is a lagging indicator. I think that's what everyone thinks of credit agencies. Moody's ratings said last week that the downgrade from AAA to AA1 reflects the increase over more than a decade in government debt and interest payment ratios to levels that are significantly higher than similarly rated sovereigns. Stock markets are not moving too much in the news today, Ted. How are you interpreting this downgrade?
Well, David, I'd have to agree with him on the agencies. Over the decades, I've seen these agencies watch a lot of companies go bankrupt, and they come in at the really last minute, and because they didn't want to come out with. But if you look back, S&P did the same thing in 2011. I think it was 23 that Fitch did it. So Moody's was just late. I don't know why they were just getting around to it now, because they had all the fireworks to be able to do it in the last 2 or 3 years. But it doesn't change anything really. I think the bigger question for probably the bond market right now is what's going to happen. It looks like this spending bill and all this is running into some trouble, and that may be a little more for the bond market than this actually, but we'll see.
The U.S. has $36 trillion in national debt, according to the Treasury Department. It began growing steadily in the 80s and continued increasing during both Trump's first term and Joe Biden's administration. This has been an ongoing trend for decades. I wonder if this has any significant impact on the real economy in terms of inflation or economic growth. Have you noticed any correlation between rising debt and growth?
Well, it does eventually. In other words, what happens is if you look at when you borrow money, you try to look and see what's my return on it. And if you look over the last 25 or 30 years, every dollar of debt that the U.S. has taken on is getting a lesser and lesser and lesser amount. We're not even getting a dollar return for it. So that's how you look at that. And then it's interesting, when you go in an exact opposite direction, you look down at Argentina, and their debt's been upgraded. And, they're actually probably doing the right things and really getting tough. And yet we're ours are getting downgraded, and we're not doing the right things. And so I think that's a tale of two countries.
Okay. This is, by the way, the deficit as a percentage of, well, this is millions of dollars, but the percentage of GDP looks similar. I'm going to point out that if you just roughly overlay this with the S&P 500, it looks like there's a positive correlation between how wide the deficit is and the stock market. In other words, it appears that in the past, whenever the deficit goes negative, that's when stock markets start to boom. I think, the exception would be 2008, but in other cases, yes. I mean, is that just we want to reduce the deficit, but yeah,
that's correct. That's correct, because maybe that's where the money goes. And the reason they're running a deficit because they're spending. Yep. And so, you're exactly right, David. That's why it happens that way. Unfortunately, it's like a short-term dope addict, and so you got to back the real world eventually. But that's the difference. And then one of the difference, in 2011 when they S&P lowered it, we only had, I think, 78 or 80% debt to GDP, U.S. debt. Now we're 120. I mean, it's a totally different game now.
The S&P is on its track to retest previous all-time highs in early 2025. It's gone up. Let's take the trough to its current level, about Yeah, it's climbed about 20% since the beginning of April, Keith. Ted, sorry. I just referred to you by your son's name. Hi, Keith. Anyway, Ted, what's going to happen next? Is this the beginning of the end for the bear market that we've seen?
Well, I don't know about that. I just know we look at companies and, one of the things we found when the markets were breaking down, and we run a lot of screens, and we got to the point where 12 or 14% of those companies were starting to get in the zone where they were really getting cheap enough to buy. And we did buy some things. But now, just in the last week, we run the screens. We're right back where we were. Everything's totally overpriced. I mean, we're back at 22 times future earnings, which is not now that's not to say the market can't go to 30 times future earnings, but I'm just saying it's expensive. Most of the companies are expensive, and you have to really be careful of what you buy.
I've just noticed, I think I pointed this out in previous episodes as well. If you just take a look at what happened since early April, which is after Liberation Day, after Trump announced reciprocal tariffs in other countries, if you just take a look at what he's done in the past, during his first term, he's announced tariffs not on the same scale as this year, obviously, but the markets reacted in kind of a similar fashion. Ted, if you look at what happened in 2018, markets went down about 20%, and then and a subsequent recovery after some resolution regarding the trade war was reached, and then it kept climbing until COVID hit. So I'm just wondering whether or not this is kind of the same pattern repeating now, Ted, when we have an administration in the White House using tariffs as leverage, and then once he gets what he wants, he reverses them, and markets think that everything's going to be all right again.
Well, that's a narrative they use. No question about that. I mean, if you look at it, they use this narrative to make sure that everybody thinks that, hey, it's like saying, okay, I'm going to cut your leg off, and then you come back and say, well, no, we're just going to cut your big toe off,
Yeah.
and you got to feel good about that. See, that doesn't make sense, but it still hurts. But the that's the idea of all of this. We're going to go huge and then come back and make you feel better, but it's a tactic. I mean, in the real world, it still has most of the businesses are still upside down on what they're going to buy, all this sort of thing. Just like Walmart last week when the president said, "Hey, you just got to eat the tariffs." Well, I doubt if they eat the tariffs. Okay, so you get into things like that.
When you said that things are overvalued, are you talking about today, or was it
Yeah, today.
overvalued in early April as well?
Well, both, but we're back up again.
Okay.
If you look at the price of the S&P relative to forward 12 months of earnings, I'm saying here 22 times, and that's really expensive. I mean, you can't say that's in a zone of a 14 or 15 time multiple where you'd really find things to be cheap, or at least cheaper.
Yeah.
And we're right back where we were. That's what I'm saying. It's almost like if you'd gone to sleep and woke up, nothing's changed at all. And I
Right.
don't think people's attitudes did either, by the way.
Let's take a look at what's going on in the bond market. So let's flip over to my screen one more time. The 10-year has been rising ever since mid-April. Let me just pull this up. Um, yeah, so it's climbed. It's been significantly higher since the start of April, and 30-year is reaching 5% again. Like I mentioned in the introduction, is the Treasury market on its way back down? You think?
Well, we've said for some times you can't buy the long bond.
Yeah.
We've tried to trade that a couple of times the last couple of years and made not much money really. And so it's just we think really the next 5 to 10 years there will be periods where maybe you get lucky on a trade for 6 or 12 months and the long bond does okay. But as far as just owning it for the long term, I don't think people can do that. And I think people have to look at the debt level and say, hey, this thing's out of line, and we're probably, I mean, they're still selling the bonds, but I think that's the problem with owning the long-term bonds.
Are you not betting on higher inflation? That's one narrative for owning long-term bonds.
Well, I think eventually yeah, you will have higher inflation. Maybe not here in the next 2 or 3 months just because of some of the base effects you're looking at. But when you get into, adding these tariffs on things that happen, you should get more inflation. I would guess that you would.
Well, what's your rationale for not owning the long end of the curve? In other words, why do you think the yield's gonna eventually top out or come back down again?
Well, let's just say the long bond averages 4.5, 4 3/4. I know it's higher than that right now
Sure.
over the next. And when you buy a treasury, they don't call them, so they're a 30-year hold. Um, and the problem with that is if we think inflation over the next decade will yield somewhere between 3.5 and 5, and if it does, that's not enough of a spread for us to want to own that because we think that's a losing proposition in terms of real return. Okay, and so you take that real return from that treasury, and you have very little left over.
Well, the 10-year yield's up 1% today. The dollar's down about 0.5%. I wonder if this rise in the 10-year and the long end of the curve today is due to the Moody's downgrade or something else. In either case, does the downgrade change your allocation or your preference towards treasuries overall?
Well, it doesn't change our allocation because all of our treasuries are short term. Now, they're all less. Well, now they're less than 20 months, and so in that case, I'm not too worried about it because you can say, okay, what's the worst case scenario? Worst case scenario is that the Fed prints, the Treasury has to print more, and we end up getting our money back. It may not, but it's short term. But it's not one of those where we want to make, when you're buying a 20 or 30-year bond, you're saying, I believe that's the best interest rate I can get for the next 10 to 15 years. And we're not willing to make that bet.
Let's just think of a scenario in which the treasury yield will be even higher. In other words, the bond market would be even more distressed later on in the year. Besides this downgrade that we've just witnessed from Moody's, perhaps more downgrades are coming from other ratings agencies. We don't know yet. But aside from downgrades, what other scenario could prompt that higher yield?
Well, those are the big three. I mean, S&P, Fitch, and Moody's are the ones those are the ones you look to, the big
Sure.
three. So they're already done. I think the biggest thing would be, there's been this idea that if you look at what's in front of Congress right now, particularly the House, that they're going to push that up. Well, there's about 30 of those people that are saying, no, we're not going to go along with that. And so if they hold that up, which they act like they're going to because there's not enough cuts, they're giving too much money away. And if they do that, then the Treasury is going to have to come back then and issue more treasuries than they probably wanted to, because you're going to be in a situation where you're up against the debt limit,
Yeah.
and all of a sudden you go into that shutdown mode again, and they're not going to shut down, but they're going to talk about it. That to me is the bigger question here, rather than what the down agencies just did.
So when you're betting on the short end of the curve, are you also betting on the Fed to cut soon? Here's the CME Fed Watch tool. 91% chance of nothing happening, no change in the rate by the next meeting in June, which is in a month from now. The probability goes down further out. What's your overview or your outlook for Fed policy this year?
David, we don't look at it like that. We're really trying to find companies to buy, and the only reason we carry the Treasury short term is because we're looking for other things to buy, and that's a good place for us to hold money in the short run. We're not really trying to worry about the interest rates come and go, and we're getting paid a nice return on those treasuries right now. And if in fact that treasury rate goes way down, that probably means we're in a recession, and then we'll have more things to buy, if that makes sense. It's an offsetting item. What we want to do is buy more companies. We want to buy more things that we really, really like, and we buy some. But when you use that money, that's what we use it for. We don't really use it to trade the treasury curve or anything like that.
I understand. Let's talk about companies you like then. So here's the P ratio, S&P. Trailing P is at 28 now. So this is it's been climbing steadily higher, like you've talked about earlier. Are you still buying at current valuations?
If they get cheap enough, I mean, I'll give you some examples. If you look at the last few weeks, particularly, oil in the last 3 years has gone from like 130 to 60. So we think we're in early stages of taking a look at oil. And so, we bought Chevron on a 5% dividend. We bought a company a small company called Matador on a 3.5% dividend. And then the tankers, the oil and gas tankers, which we bought some time back. We like those because, particularly TK and Frontline, we we think that they'll still be shipping oil, even though there's a soft spot here probably, that the rest of the world is going to be coming out and they'll be using it. We do things like that on, on the stock side. We do Unilever, and we still buy McDonald's. So, there's a no, AbbVie we just bought, maybe 6 weeks ago. We buy companies when they get in the zone of what we want to, what we want to own. We added to our silver stock, Pan American Silver, here about last week or so. When they get in where we feel like they're cheap enough, then we buy them, and we have a number of companies we look at.
Mhm.
And when they get to a zone where we can viably say, okay, look, you know what, this company's going to do well the next 5 years, because we try to hold things long term. In other words, more than 5 years. But if we get to that point, then we'll buy the company. And if all of these stocks just keep on rambling higher and they get really, really expensive, we're not going to participate in that necessarily, particularly for new money. And we've owned a lot of companies we've owned for many years. You look at Visa and MasterCard, Microsoft. We've owned those companies for many years, by the way, and they've been great for us, but they're not necessarily in the zone where we would find them to be terribly cheap right this minute.
I'll get to oil and commodities in just a minute, but you brought up Microsoft, so it's one of your it's one of your holdings, Ted. So
Yeah.
huge jump up recently. The tech sector overall. How are you feeling about this space?
Well, you can't rule out. Microsoft's one of those companies we've owned, like I said, a long time, and it was one of the the only company really that came out of the tech bust of 99 to 01 or 02, and actually went to a new high. A lot of those companies never made it. You take that group, but they did. They changed horses, changed a lot of things they were doing, changed business models, and so they've done really well. We still look at them though on the basis of cash flow, and right here, we're not going to be buying tons of Microsoft. We own it much cheaper, but on the long run, it's a good company. But some good companies are just too expensive. The rest of the tech, the rest of the tech group is still fairly expensive too. So we're particular about where we buy those.
Going back to oil and commodities, focusing on oil first. The crude oil price is at the lowest level since I believe 2023. Actually,
Yeah.
if you take the trough from earlier this year, it actually goes back all the way to 2021. So we haven't seen these levels for quite some time, Ted. When you're looking at this, obviously, on the one hand, like you said, probably a buying opportunity. But are you concerned about this longer term trend of just depreciating oil prices, especially adjusted for inflation? Oil is actually quite cheap compared to what it was a couple of years ago. Does that prompt you to sell some of your oil holdings?
No, matter of fact, we buy them because we think we think that now you're getting a lot, I think you're getting more and more from solar. I don't think you're getting as much from wind, but oil, when you went through this green area, it really, people got away from it. I think they're going to realize, and you're starting to see it. I mean, you look at in the Wall Street Journal about General Motors, like, hey, we're going to have more fossil fuel cars. We're not selling the EVs, and that's happening all over these companies. And I think you'll be using more oil again. And like I say, it's had a big correction. You just
Yeah.
call it 50%. And you got to get in front of this stuff and buy the right companies. And if you buy the companies that pay a good dividend to you, Exxon's another one, you can afford to hold it because, like with Chevron, we get more on the dividend than we get on the treasury. And so it's that kind of thing you do. You try to get in front of it. And we feel like that's the next move you'll get from oil over the next 12 months. It'll perk up.
I'm just using Exxon as an example because it's one of the biggest, but we can take other companies. But why has Exxon in particular outperformed oil over the last 5 years, over the last 1 year, and actually year to date as well? It's down less than crude oil has. I mean, you typically think of stocks, especially in the resource sector like gold and silver, as being a leverage play. In other words, it has a higher beta. If the commodity goes down, it'll go down more. But that doesn't seem to be the case.
Well, I think the biggest reason for Exxon, David, is because if you go look at the two primary exchange traded funds that are oil, then Exxon is
Mhm.
a huge holding in both of them. In the
I
same
see.
way, so when they buy them, it's the one that gets the kick because it had, it's the largest holding. And so that's the reason for Exxon. I'm not saying Exxon's not a good company. I'm just saying that that's one the flow of that is the reason why Exxon gets a kick.
What's your take on small caps right now? Are you looking into that space? Is that good value now? I mean, it hasn't climbed back as much as the S&P 500. I mean, if you just take a look at where it was previously a couple months ago versus where it is now, it is up about 20% or so, which is the same percentage point or percentage move as the S&P from its trough, but it hasn't nearly retraced as much ground as it's lost.
For us, David, we don't really emphasize too many in the small cap area for this reason. They're not liquid enough for us
Okay.
because we have to buy a lot and sell a lot if we sell it, and they're not liquid enough. And the other thing is when small caps really do well when you have inflation really popping real hard high because they can adjust a lot quicker. We haven't had that. It's higher, but it's not to a point where the big companies can't adjust to, and they were able to finance a lot of things at cheaper prices, 3 or 4 years ago. But small caps, I just don't think it's been their day. Now, if you want to own some of them, it's fine. But for us, it doesn't have the capacity for us to own a lot of them.
All right. Let's move on to the precious metals. You mentioned silver and gold earlier. Gold has had a great run this year. It looks like it's been losing some steam ever since the reversal of the tariffs May, where come mid April. That is, if you take a look at what it's been trading at relative to the S&P, the inverse correlation is starting to come back now, Ted. I wonder how you're positioned on or how you feel about the precious metals relative to the stock market here.
Well, I have to say, David, I don't think they're finished. Now,
Mhm.
that's not to say, though, and I think people should be aware of this, that if you had a 3,500 gold price and gold corrects to 2,900, let's say, that's fairly normal after you get a really big move in gold. And what you don't want to do in these sorts of things, if you believe in it over the next 5 years, which we do, you don't want to get shaken out on that downtick because you'll start to think, hey, this thing's over. It's going to go back to 1,500. And we just don't think that's going to happen the way the world's structured today. So you could easily get a shakeout more here. And I think people, if you don't own gold, that's probably not a bad time to look at it if it's weakening, and look at some of the miners. But one of the things I've always found about gold for us is that you can't really trade it real well. You have to own it. In other words, if you're going to own it, you just own it. It's going to go through times when it doesn't do well for a year or so, 2 years sometimes. But that's why we don't own, the whole portfolio in it. But we have enough, and so that's how we look at it.
Year to date, and I'm just taking the beginning of 2025 to now, the gold miners are starting to outperform the bullion. This was not the case last year. If you just zoom out, you can see that if you scale back a little bit, the gold bullion has more or less performed the same as the miners, and in some periods last year, it's outperformed the miners. But why is it that this year in particular, we're starting to see an outperformance in the miners, especially when the S&P has had a really bad 2025?
The main reason we think, David, and we own the miners,
Yes.
some of them, is that people can now see, before they were saying, hey, these companies are going to make a lot of money now that gold is going to see. It's a lag period, though. Spot price goes up, and then, you've got to wait 6 months. Now, all of that feeds back into the pricing. So now you're starting to see it. Like if you look at, we have some gold companies, you look at their price to cash flow, it's really low relative to, where it was, say, in 2011. And so now it's catching up, and people are saying, okay, well, let's price these things out at 2,800 or $3,000 gold. That's what we do. And they still make a lot of money. I mean, a lot of money, a lot more than they've ever made. So I think that's just now catching up with them.
Are you expecting more M&A in the space? In other words, if you are, would you be positioned more into the juniors?
We don't buy the juniors because we're not good enough to know much about
Okay.
them. And I know a lot of people that do, and they're really good at it. and my hat's off to them. And they're probably, yes, I would say a lot of those juniors will get taken out, but that's not a space that we buy into.
Okay, so your thesis for the seniors at least is that their free cash flow is higher than I guess normal, and they're able to expand
Yeah,
quicker.
price to cash flow is really good for the
Okay.
companies, the top 10 companies. I mean, their price to cash flow is great. I mean, we added a small gold stock 2 weeks ago that they're not a big position, but a big small gold stock that's selling at 3.5 times 20 and 26 cash flow. I mean, that's cheap. You know,
Yeah.
and that's at 2,800 gold. So, you look at things like that and you've got a buffer. Now, that's not to say it won't come down some, but it probably is going to do well over the next 3 or 4 or 5 years.
So finally, finishing off on markets, I want to get back to your book now, Ted. Are you still more defensively positioned in terms of your posturing? I'm getting the sense that's still the case.
Well, it is only because we can't find the companies we would like to buy. We find a company, we buy them. Don't get me wrong,
Yeah.
but uh, as a group, okay, and let's say we're looking at probably 300 companies that we'd like to own, we could own, and those companies right now, we just don't have that many in that zone right now. But energy is one of them. That's one of them. We have, a couple of special situations. Bought a little Otis elevator, a couple weeks ago, and not a lot, but a lot of some of those companies are getting in a zone where they're cheaper now, so we take a look at them.
I'm curious as to whether or not you and your firm have a screener in place, like a criteria. You have to like a hard criteria you use to screen stocks to buy. I wonder if that changes per changing macroeconomic environments. For example, today, do you, given the uncertainty around the economy and tariffs and today's debt downgrade, for example, yields going up, do you have like a certain price to free cash flow ratio that under which or over which you would just not look at size, valuation, sector,
Right.
things like that? You would just say, hey, these are red flags, move on.
Well, they are. If their debt to equity is too high, that's off for us. Okay.
Okay.
If they've had significant management changes, multiple in a row, that's off for us. A lot of companies are cheap for a reason because they're not really good companies,
Mhm.
and so those are off. But when we're looking at a company, if we look at something, and let's say we have an idea, we think what they will make this year and over the next 5 years plus, and we look at that company and say, on a multiple basis, that company is now back to where, let's say, the low end of the range for the last 10 years. And if it is, then we start to look at it and then we put a discount below that. So maybe we put a 10 or 15, 20% discount and say, that's the spot where we'd own this company. And some of them hit that spot. We'll buy them. And this is what that does for you. It allows you not to take really, really big hit. The individual investor needs to always remember this. The thing you want to guard against is the big hit, the big loss. And so the way we buy companies, we're not going to lose a lot of money in them because of where we're buying them. And I think the individual investor has to remember, what do you want to look out for? Number one, like Buffett says, don't lose money, and we hate to lose money. And secondly, uh, you know, buy the companies that give you a buffer of safety and for the next, and if it doesn't work, the worst case scenario is it didn't do quite as well as you wanted, you move it on, but you're not buying it at the high end of the range where the next thing that can happen is to go to the low end of the range.
Yeah.
Then you're really in trouble.
But do your metrics for screening stocks, do they change for the cycles? In other words, let's say we're in a bear market right now versus let's say, in the 2000s when there was a soaring bull market. What do you kind of change the way you start here? Like do you look at more aggressive versus more defensive stocks to
That's
begin with?
that's a good question. We don't change it a lot, but
Okay.
what you do change is this. If you have the markets coming at you all the time, they're coming down, down, down. You're thinking, okay, normally I might be buying this at a 10% discount, but I may be able to buy this company at a 25% discount to what we think the value is
Yeah.
because they're coming at you here. And we'll take a little leeway on that. I think that answers your question, but we'll
Sure.
change it a little bit if that's happening. We don't change it much on the upside though, because value is value. And if we can't get the right value, we're not going to chase that company. And I think that's what does a lot of people in. They chase these companies and then they're sorry they chased them. I know individual investors are really into the big Mag 7. You take Apple, number one owned stock amongst retail.
Mhm.
You know, nobody's going to listen to you on that right now, but you have them go the other way and they'll start to think about it.
Let's talk about second generational wealth. So, your book centers around, this is a relatively short read. People can get it, 76 pages. People can read this in 2 hours or so. But it centers around passing down wealth to the next generation. First of all, before we get into some of the details here, have you noticed that there's been a trend towards how people are storing the wealth these days? Is it more into stocks, real estate, digital assets? Has it changed over the last couple of decades?
Oh, no question about that. I mean, if you look at the wealth today, particularly people over 55,
Hmm.
they are all into the marketplace. I mean, bigger than they ever have been. And we've got all the numbers. I mean, they've ever been. So they really believe in stocks and they've got a lot of them. And that's where we are. That's where a lot of the wealth has gone is in those companies. And, it's done well enough and they haven't been hurt badly. So they don't feel any big need to have to get more conservative.
Page 51, you've got a few guidelines for the timing of financial gifts.
Uh-huh.
As number one, don't give too soon. Your 18-year-old doesn't need a Ferrari or a condo in Palm Beach or $500,000 in the bank. Number two, don't impede independence. And then number three, don't feel the need to go all in. Number four, don't wait too long. All right, so that is a contradiction. Well, not a contradiction, but that's different from number one. Number five, turn to trusts. Every billionaire I've ever interviewed has told me the same thing with regard to ensuring financial security for future generations, that they will manage the flow of wealth through trusts. I guess these are kind of mistakes you've noticed with estate planning. So walk us through some of these lessons here.
Well, I think there's an idea out there now, David. I've seen a lot of these family counseling firms and planning firms. They go to the really billionaire types, big money, and they talk about, okay, we're going to take these kids at a real young age and bring them in and show them the money and all this sort of thing. We just disagree with that. I mean, I've seen, and the reason I say that because everything I put in there is my observation about people that have done it right and my observation about people that have done it wrong. And I've seen a number of billionaires, by the way, do it right. So it doesn't mean you can't have a lot of money and do this right. But what they do is they don't bring these kids in at 12, 15, 18 years old and talk about how much money you have. They kick these kids to the curb and say, hey, you need to spend 6, 7, 8, 10 years, whatever, on your own. You need to learn to be self-sufficient, stand on your own feet, have self-esteem, learn what the dollar is. I've always said if you've never experienced the lack of money, then you're never going to know the value of money. And that's what happens to a lot of wealthy families. They think that, well, there's a way to go about it where we can make them feel really good and bring them through that. Well, you know what? You're wasting your time. In my opinion, you are. I think what you need to do is have these kids be able to stand on their own 2 feet. And then if you want to bring them back in, and you should eventually, bring them back into the wealth, they'll understand it more. They'll know what's happening. And when I say don't do it too early, that's what I'm saying about these younger people. When they get into their early 30s, different story. They've been on their own. They're doing the same thing. They understand money then. And then if you want to bring them back in the family office or bring them back in the business, that's okay. But by that time, you've got an individual that knows they can make it even if you don't have any money. And I think that the whole group of people with wealth have been sold a bill of goods from this community that goes to them, our business, and says, hey, we're going to make your young kids feel really good about the wealth. Well, you know what? It probably doesn't really work that well. And that's just our opinion from watching it for different people.
Here's the thing is, let's say I have a big trust waiting for me that vets in 10 years, and let's say I'm 22. Well, I'm not going to work because I know by the time I'm 35, I'll have this money ready for me, right? How do you mitigate that?
Well, number one, I'm not going to tell you.
Oh, okay. All
We're
right,
not going
fair
to know.
enough.
That's the whole key to this whole thing.
Okay.
You know, you don't you have to be an example here for your kids. I mean, I blame a lot of the parents because, you know, you don't let these kids know that you have a lot of. They know you have house in Aspen, and they know you have a lot of things, but you don't really stress on it a lot. You know, when they fly around the Southwest. Okay,
Mm,
you know, they drive a car that's 7 years old. You don't put them in like a lot of these kids I see in high school that have a Lamborghini SUV.
hmm.
That doesn't work.
Yeah.
What you want is don't tell the kid anything. And and I'm not certain you want to set that trust up, but I think it's good to have it set up like that. Typically, on most trusts we see, you know, it's a 35 years or later, and by that time they know a lot. I mean, they can handle it, but you don't ever tell them. You don't tell them anything. In my opinion, you don't tell them a lot anyway. You can say they know you have wealth, but to sit down with a 20-year-old kid, 21-year-old kid, and say, "Look, I'm going to show you what $900 million really looks like." So if you take away all their ambition, all their self-esteem, and they're like, "Gosh, I'll never be what my mom and dad are." Well, forget that. Let them go out and learn how to do things, and I think you'll raise a much better child.
Let's say for the average family that is not a billionaire or even worth, 8 or 9 figures, how do we plan for our kids' future? Should we even bother putting aside money in a trust or some sort of fund for them, or should they be on their own?
Well, I think the number you're using, 8 or 9, is somewhere between 10 million and 100 million. I'm going to use that. I think that's
Yeah, yeah,
what you're
sure.
saying.
Yeah, that's a big difference.
And I would say no, not in the beginning. And I would say no. There's a number of things that come into play here. When you only have, when I say only, I know people will think odd about that, but when you're dealing with 10, 20, 30, 40 million, it can get gone in a hurry. And so you don't want to early on put a bunch of that money away because you, number one, you may need it.
Mhm.
And number two, uh, let it play out a little bit. You don't know what kind of person they're going to marry. They may marry somebody that, gosh, this is not going to work for giving them money here at all right now. There's a lot of things that enter into that. I think down at that level, yes, you will eventually have trust at the death of maybe one or both parents, but to do it early on, I don't agree with at that level because there's really not enough wealth to start doing trust right at that moment. Eventually, yeah, you can look at doing something like that. But, I know it sounds odd, but if you look at 10 to $20 million today, there may not be a ton left over for kids. You're going to live a long time. You're going to have a lot of cost, and so you'll just have to see how it goes. But again, another reason to have those kids stand on their own 2 feet.
Well, 52% of adults surveyed don't have a will. That's a stat here on page 40.
Mhm.
Is that a mistake or no?
Oh yeah, that's a mistake. And a lot of those, when you look at those, when they look at those polls, for example, or talking to people, you
Yeah.
got to realize a lot of those people are down at a level where they don't need a will. I mean, they're not in a zone where they're even paying estate tax. And so there's a lot of that. So they don't think they need a will. But a will is the best thing. People need to realize a will allows the people that are left to handle your business the right way without having to go back to the courthouse and get everything approved and get you approved because you're next to kin. And it also allows you to do with the money what you want. I mean, there may be situations where, it goes per serpes or whatever, and you're like, you know what, I didn't want that uncle of mine having that money or whatever. So you want a will. Yeah, you want a will for sure.
What is the biggest takeaway that people should walk away with after reading these 76 pages?
Well, the biggest takeaway is it's up to you as a parent, number one. Don't slide that responsibility off to some family counseling or family planning firm. Okay, it's up to you. All right, and the best thing you can do for your kid today. All right, it'll be harder for you to do. I know that,
Hmm.
but once they get out of college, you pay for the college, but buy them a car or whatever. But once they're out, they're on their own. You kick them to the curb. They got to make money. You have to pay rent. They have to take care of insurance. They have to pay bills, and they will learn what it's like to have to handle money. That's the best thing you can do for that kid. make them work from the time they're in high school. They got to work every summer, work between college semesters, and work is one of the greatest things you can do for a kid. And people are not doing it now, but I think they're missing a great learning experience for a kid.
Let's say before they're on their own as an adult, making their own money, how should we as parents give our kids an allowance?
Well, I always say don't go over a certain percentage. If you add up the amount of money you're giving your kids, and it'll sneak up on you. But if you say, okay, I'm paying for their house, I'm paying for the private schools, and I buy them a new car, and you start adding it all up, and all of a sudden you're 50% of what the kids are doing, then you're over the line. You know, if you want a gift to them, you know, we got fairly large gifting now every year. That's okay. If you want to help them, I think, with, you know, a tuition for a kid, I think that's okay. But when you get into covering their living expenses day to day, I think you cross the wrong line.
All right. Well, this book goes into a lot more depth than what we've talked about so far. There's also a chapter on in-laws and extended family. There's a chapter for the third generation. So a lot of interesting insights here. So again, it's not a terribly long read. People can get it, you know, done in a couple hours or so. Where can we find this book?
Well, you can get it at our website for sure. You can get it at oxbowadvisors.com or Amazon or Barnes & Noble as well. And I would say one thing, David, at the last thing I write about in that book is to the parent to say, look, if you've done everything right and you've done everything you could do and you've done it the right way and that child still doesn't turn out the way it should have been, you cannot go on a guilt trip here because you've done what you should have done. And they're individual people. You can't control them. Yeah. And so do the best you can, and you have to go on down the road. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.